Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com looks at how the major markets reacted to trouble in the Middle East and the U.S. getting through stage one of its trade agreement with China. Author of the book The Money Bubble, John Rubino, chimes in on how record-high markets could be risky, the vulnerabilities we face from fiat currencies, and how your life raft might be made out of gold and silver. InsideTrackTrading.com President Eric Hadik examines the major cycles that affect the stock markets, gold, interest rates, and oil. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and Cypress Development's Don Mosher. We'll talk to Ross Clark right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Ross, we saw phase one of the trade deal between China and the U.S. signed, the U.S. Senate approving the Canada-U.S.-Mexico latest free trade deal. What was the reaction on the markets to all that?
Well, you'd expect these type of events to be a sell the news item, in that, clearly it was already theoretically priced in, but markets held up exceptionally well. You've got new record highs into in the close for the week on Toronto, New York, and pretty much everywhere for this rally right now. So, looking good. However, when things are moving along as smoothly as this and starting to get euphoric, that's when all of our little flags kick in. And we've got signals as of this Friday that we haven't seen since January of 2018. So the excesses are pretty big as far as the S&P and the NASDAQ is concerned. The Dow is not quite into such extremes, but when I look back, the S&P has only seen these kind of readings maybe half a dozen times, or the SPY, which is the ETF on the S&P, since 1996 when they started. This is only the eighth time that we've had it this overbought. And the norm here is that you're going to get a 5 to 10% price correction, probably back towards the 50-day moving average or under, and you would expect to see that within the next 2, maybe 2.5 months. So, we've been watching this thing rally as it moved through our optimum date of January the 8th. It became very important that it not turn from there, that it continued up, which it has. And for short-term timing, we're looking at a 10-day moving average as the key support. As long as that stays in place, then trend is up. But as soon as you see a violation of that, I think that's the point at which you can be looking for the inevitable correction to commence.
In the Middle East, of course, we had the assassination, then the missile counterattack, the downing of the airline. Have the markets settled down after that, or was there much of a reaction to it?
There was the immediate reaction when tension started to ease. That was, a week ago Tuesday? And, after kissing the $66 mark, it immediately dropped below 60. And it's stayed down, and it's down enough that we look at a relative strength index, and at this point in our 10-year cycle that we monitor, it went into overbought or oversold condition on Wednesday, a small reversal up on Thursday, Friday. That's where we would expect it, and it's given back half of the gain from the lows that we had back in October. So this is a normal spot to start seeing a consolidation form. I've got a rising moving average channel that we've worked with just beautifully here for the last, 8 or 9 months now. And, it was right at the peak at 66. I think it overlapped it by 40 cents. And the lower channel at this point is still around 56 and coming up. With the low of the week being around 58, I wouldn't be so surprised that maybe there's one more sell-off towards that 56, maybe another oversold condition, and hopefully that sets us up for the next run. Once again, long-term cycles are up right in through the fourth quarter of this year, early next year, with a few blips along the way. And, we're seeing one of these hiccups or blips right now, but I think if we can establish a decent base in here, we've got pretty good upside potential.
Now, China says that they are seeing their economy recover and had 6% growth in the third quarter. Are the numbers believable, or is any kind of positive growth in China good economic news for the planet?
Well, definitely good news for the planet. If things are going to stabilize over there and, I guess anywhere else in the world, 6% growth or even a fudged, 4 or 5% would be, everybody would be ecstatic. They, as far as I can see, you always question the stats out of China, but markets as a whole, we take a look at them. Even the Chinese market, if you look at the A shares, they're like everything else, trading right up near the highs of the year. So, I look at markets more than I try and judge the fundamentals, and trends over there are looking pretty decent right now.
Ross, thank you so much for the update.
And we'll see you in a few weeks, Jim. And anyone who wants to follow me on Twitter, it's Charts by Ross.
My guest has been Ross Clark from chartsandmarkets.com. Coming up next, John Rubino on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm speaking with John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to This Week in Money, John.
Hey, Jim. Good to be back.
The S&P 500 again hit all-time highs over the week. We're hearing predictions it could hit 50,000, 75,000, maybe even 100,000 on the Dow. What are your thoughts?
Well, the reason this is happening is because all the central banks of the world and all the major governments of the world are flooding the global economy with basically free cash. They're just creating new money and sending it out there. It has to go somewhere. So it's flowing into the stuff that the people who already have financial assets and who tend to get most of the new money that's created have. In other words, rich people get first crack at the money that the Fed creates. They already have all the stuff that they need, so they invest it in trophy real estate or fine art or blue chip stocks. And so that's sending the stock market way up. That part of the fundamentals of stocks is continuing because all the central banks they've basically given up on ever trying to normalize monetary policy. So they're just going to go pedal to the metal, low interest rates, quantitative easing, other kinds of monetary tricks forever, basically. And that means the stock market is going to have the wind at its back financially forever. But at the same time, equities are at nosebleed valuation levels. Now, they're pretty much where they were right before the last three big stock market collapses. And so it's a tough one right now to talk about where equities are going, because all this money's coming in to the system, has to go somewhere. But the price that you got to pay now to buy Google or Netflix or Tesla or any number of other high-flying stocks is ridiculously high compared to their cash flow. So I wouldn't be a buyer now just on historical principle. You should never buy at these valuation levels. But it's possible that this time is different in the sense that there are no central banks leaning against the wind here. Everybody is on the same page, which is of extreme ease. And all the big governments of the world, or most of the big governments, are running big deficits at a time when they shouldn't be, 11 years into an expansion. So, I don't know. That's why everything's up. That's the dynamic. But it could lead into two very different worlds, depending on which ends up being more important, valuation or monetary policy.
Are interest rates still likely to go negative in North America?
Well, yeah. As I said, we're 11 years into an expansion. The normal length of an economic expansion is 6 years. And the reason that there's a business cycle is the reason that there are expansions and contractions is that the further along an expansion goes, the fewer good quality borrowers are left who haven't already borrowed a bunch of money. Banks lend to their best potential customers first. And then when those guys are all loaned up, there's nothing else you can lend them money for. You look at your mid-range customers. And when you've given them a lot of money, you go to subprime. And we're into the subprime part of this now pretty much everywhere, whether it's, really crappy, zero free cash flow fracking companies borrowing a ton of money in the junk bond market, or tech stocks, financing themselves by going public at insane valuations, or houses at affordability levels where the vast majority of people in a given city can't afford the average house, and how do you keep prices going up from there? But that's what people are lending on, or what bankers are lending on now. They're financing people buying houses at a time when house prices are ridiculously high, and where historically they've gone back down after they got this high. So we're really deeply into that process. In the Austrian School of Economics, they talk about the different phases of credit creation that a society goes through during the business cycle. And, the beginning phase is called hedge financing, when all the money that's borrowed is for productive reasons, and it's usually backed by good collateral. And you go all the way out to what they call Ponzi finance, where money is being borrowed in order to pay the interest on past loans. And that's something that blows up in your face very quickly. And we're in that phase now. We're in the Ponzi finance phase of this business cycle, and maybe of the super cycle. Maybe of the last 200 years, which has bigger, longer cycles than the 10-year business cycle that we normally look at. We're at the peak of one of those too. And because of that, the crash when it comes could be pretty spectacular, just because you've got not just a few years of bad credit being created. You've got all the decades since World War II, in which there was a ton of bad credit that was created, most of which is still around. And then you've got the longer cycle, which might date back to the beginning of the Industrial Revolution, which also, according to long wave theorists, is now peaking. So you got cycles and super cycles, all kind of coming to a head right now. So all of the debt that we've taken on will have to be worked off somehow, and there's only a couple of ways to do that. In normal times, well, actually, ever. There are kind of physical laws of finance that only allow you to get rid of debt a couple of ways, and one is to inflate it away, and destroy the value of your currency to get out from under it. The other is to have a depression in which lots of people go bankrupt, and the debt is worked off that way. It's wiped out through default. So we're kind of stuck with one of those two options right now. And the amount of debt that we're dealing with is vastly bigger than anything that's come before. So you got to think it's going to be pretty spectacular when it happens. However, unlimited central bank printing presses have turned out to be a great way to delay that inevitability. I think you can make the case that we should have, the cycle should have ended in 2000 when the tech stock bubble burst. And then it really should have ended in 2008, 2009 when we had that derivatives-based near-death experience in the global financial system. But each time the central banks have been able just to flood the system with new money and get us out of the immediate problem. But that was at a cost of vastly increased debt. Every year the global financial system takes on more and more debt. It doesn't wipe out old debt. It just layers new debt on top of it. So we're at record levels by any measurement that you want to use now of leverage and indebtedness. So the next downturn, which is inevitable and probably imminent since we're 11 years into this cycle, will force the global financial system to deal with maybe twice as much debt as it had to deal with in 2008, 2009 when excess debt nearly blew up the system. So it's going to be spectacular when it happens, and something that you really want to watch from a safe distance. You don't want to be too plugged into the fiat currency system when it blows up on you.
Would you rather be in the Canadian dollar or the U.S. dollar?
I would probably say the Canadian dollar. You guys are extremely rich per capita in natural wealth. In other words, there are not a lot of you, and your country is very big and it's full of energy resources and timber, and soon, if the world keeps warming up like this, you'll have massive amounts of high-quality farmland and gold and silver. You've got everything, and not that many people to spend all that wealth. So I think you guys have a pretty good chance of getting through this in better shape than Japan, for instance, or China or the U.S. We're the big debtors out there. And the most leveraged financial systems. So as long as you guys keep your banking system under control and don't let it spaz out like most banking systems did in the housing bubble in the previous decade, you ought to be okay because you've got a lot of natural wealth to fall back on. The U.S. has a much bigger problem because there's a lot of us, and our per capita debt is immense, and the leverage in our financial system is ridiculous, So I think there's a good chance that a lot of dominoes fall in the U.S. with really nothing to stop the next one from falling and then the next one. We just have a leverage everywhere you look, whether it's the auto loan market or the student loan market or credit cards or mortgages or the government, and what will end up happening is that the government will have to bail out all those other entities. Oh, and pension funds. So the pension funds blow up, ex-students, stop paying their student loans, all the subprime car loan buyers go bust and can't pay their car loans off, and the global or the U.S. economy starts to implode because of all these mini bubbles bursting. The federal government will have to step in and start buying up all this debt. Basically, take all this bad debt that I just went over and put it on the public balance sheet, like we did with housing. We basically nationalized the house market in 2009, 2010. So something similar is going to happen this time around, only with a lot of different things going wrong. We'll have to figure out what to do about pensions and student loans, et cetera, and it's going to be a way more complicated thing, and the amount of money that's going to be at stake is going to be much bigger. And I run a site called dollarcollapse.com, and the basic thesis of that site is that when the governments of the world are going to have to bail out everything in sight with newly created currency, then the supply-demand imbalance that flows from all that currency creation will cause the value of these currencies to collapse, which is really the end of long credit cycles. Normally, you build up too much debt, you have to get rid of it by creating a lot of new currency, and your currency crashes in value. That happens all the time to individual countries. This time around, it'll happen to the whole world. All the big fiat currencies are in basically the same boat, and that means when when, for instance, Europe is bailing out its pension systems and its public sectors, which are just so bloated, and what's left of their private sectors that start to go bankrupt, and when the U.S. is bailing out everybody in sight, and when Japan, with their national debt that is greater per capita than any societies ever in history, when they start to go, people will look around and say, wow, all these currencies are being inflated away aggressively by their governments. And there's no real exception out there. There's no place to hide. So they move their financial assets, in other words, their bank accounts and the cash under the mattress, et cetera, into real assets. You buy gold and silver coins, you buy farmland, you buy, rental properties in stable real estate markets, you buy energy assets, things like that governments can't make more of as they're desperately creating new currency to bail out the bad debt of cycles past. And so that's, the dollar collapse thesis, and then the investment thesis that flows from it is that you want to own a lot of precious metals. And with what you have left over, you want to own a lot of other kinds of real assets. And you want to get as far away from dependence on fiat currencies as possible. In other words, don't own bond funds that pay you X number of dollars per year, because the value of those dollars will go down, which makes your bond fund's value go down, which means you have a big capital loss, or you have a loss of purchasing power over time, depending on how you handle it, whether you sell that bond fund or whether you keep collecting those dividends in ever depreciating dollars. You don't want that. And you don't want a house in an overvalued market. Like if you're in a kind of a bubbly market right now, don't buy a bigger, newer house. Just pay off your mortgage and kind of make sure you've got a place to live that's guaranteed, You don't want to take the risk of not being able to pay your mortgage, losing your house, and then, being in the middle of the second Great Depression and homeless at the same time. So, a good source of general advice on this is Peak Prosperity, run by Chris Martenson and Adam Taggart. And they're I don't want to say motivational speakers because they're a lot more than that, but, they help people develop resilience in their lives in the face of hard times coming. And it goes way beyond finance. I can tell you about buying gold and silver and everything, but they can tell you, how you manage a job or 2 or 3 jobs in this kind of a situation, make yourself indispensable at work. And so you are the last person laid off, and how you homestead, how do you buy a piece of land and put a garden on it that you can store the vegetables and the fruits and things from it for the time when they're not in harvest time, and how do you raise animals and stuff. They can tell you how to do all that stuff so that you are prepared for crazy times when they happen. And a lot of this, when you think about it, is just things that we should already be doing, but we've been suckered into the idea that things are going to be normal and good forever, and we don't really need to be resilient. We can buy a McMansion in a suburb that's an hour away from where we work and think that's a sustainable lifestyle, but it's actually not. Let there be an oil crisis because of geopolitics or because of internal factors in the oil market, and let gas go to $10 a gallon in the U.S. And your lifestyle, along with all of California, ceases to make any sense. It becomes unmanageable financially. Just driving to work makes it impossible for you to pay your mortgage in some circumstances like that. And all of suburbia is looking at that kind of thing.
What's happening with China's economy?
Well, China borrowed so much money to get itself and the rest of the global economy out of the 2008-2009 Great Recession that it basically quintupled its debt. And so now people talk about the Chinese miracle and, are astounded at how fast China has grown. Well, you know what? It's easy to grow when you're quintupling your debt. If you're taking in all that money and spending it, you're generating lots of new action. But now China has quintupled its debt. It now has debts it has to pay off. And so it's seeing rising levels of defaults, for instance, among a lot of companies, both private sector and state-owned. that are those are straining the government's finances because the government feels the need to bail these guys out. That's not a capitalist economy where if somebody gets into trouble, you let them fail because that's how it's supposed to work. There have to be consequences to bad behavior. China just bails out its big companies or takes them over and reorganizes them or whatever. It doesn't let them fail, let all their workers be laid off because they're terrified of civil unrest turning into a revolution. Or turning into a civil war, which turns into a revolution. Because they've seen that happen in living memory. That's how China went communist. They had gross inequality of wealth and income that enraged enough people for them to take to the streets, which turned into a civil war, which ended with the communists taking over under Mao Zedong. China doesn't want a replay of that. So they're basically willing to do the same thing the U.S. is, which is to just flood the system with money. They will lower interest rates as far as they have to. They will create as much new credit as necessary. They will change the banking rules to make it easier and easier to leverage yourself if you're a bank or to lend money to less than pristine credits. They'll do all that stuff because they can't afford a really deep recession in their situation. So you've got the whole world in this same boat. The U.S. tried to raise interest rates in 2018, and then we had a flash crash bear market in December of that year, which terrified everybody and caused the Fed to go back to cutting interest rates. And now that's where we are. China is going to be a powerful country regardless, but they're probably going to have some kind of a serious downturn in the not too distant future just because of all the debt they took on. Europe is just a basket case. There's nothing you can say about Europe that makes it seem like that's a sustainable system. So all of this stuff is lined up and ready to happen, and it will probably happen sequentially. In other words, something will blow up, which then pulls the rest of this stuff down because everything is kind of levitating on this sea of easy money while debt continues to increase year after year, which means somebody will blow up somewhere. And then the rest of these guys are so fragile that they'll go down too. And that's just how it will happen when it happens. It might not be this year, might not be next year, but it could be. It could be this week. There's no way to know. So you really need to start preparing now for this thing, even if it's a few years out, because it might not be a few years out.
We had Dr. Mark Faber on the show in December, and he says he sees a severe and lengthy recession ahead for Canada. What's your thoughts on that?
Well, I see a severe and lengthy recession for everybody. Canada's not immune to the vicissitudes of the global financial system and the global economy. You'll suffer if we suffer. But, as I said, you guys start with an awful lot of real wealth. And to the extent that real assets go up in a world of failing fiat currencies, your resource wealth will become more and more valuable. So I think you'll be okay. Don't go buying a bubble market condo or something like that. I know that Vancouver's real estate bubble has kind of eased back a bit, but I still think you probably don't want to go to there or Toronto or someplace and plop down your life savings and take out a gigantic mortgage on some piece of highly appreciated real estate. Don't be doing stuff like that. And obviously avoid wildly overvalued equities compared to their historical valuation levels. Just because those are extremely risky things to do, and they can blow up your life wherever you are. But if you stay conservative and you live in a place that has a lot of natural wealth, I think you're in better shape than the vast majority of people. So I'm less worried about you guys than I am about people in downtown Los Angeles or, Boston or someplace like that where the food supply chain and the energy supply chain is very possibly disruptible, and then what happens? You're all jammed up together and you're hungry. So you don't want to be in a place like that unless you've got a very serious escape plan, and you don't want to own wildly appreciated financial assets unless you are ready to assume that those things can defy gravity for another 5 or 10 years, which, while possible, is highly unlikely.
We'll have more with John Rubino right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Rubino. John, are gold and silver in bull markets?
They seem to be. I think gold is up, 20% in the last year, and at maybe a 7-year high in U.S. dollars. And it's at record levels in most other currencies. So yeah, it's, the precious metals are heading up for the reasons we talked about before. This is a perfect environment for real assets. In other words, for sound money like gold and silver, because the world's governments are actively trying to depreciate their fiat currencies. And in a world like that, you want to own real stuff. Gold and silver are all the ultimate real stuff. So I think this bull market could easily exceed previous bull markets. That means well up into the 2000s for gold. And there are a lot of other people out there with $5,000 and $10,000 predictions for this time around. And I wouldn't be surprised if it happened. I think the intellectual challenge is hanging in there, not selling before that, But I would love to ride some gold and silver up to $10,000 an ounce gold and $200 an ounce silver. So here's hoping.
For people who don't have a lot of money, is averaging a good way to acquire precious metals? Buy a little bit every month instead of going all out?
Yeah, because you can't know what's going to happen in any given month or 6 month or really 1 year period. The general trend with precious metals is up and has been since 1971. But, within that long cycle, there have been a lot of really brutal bear markets. So you never want to jump with both feet into something like that. And dollar cost averaging is the way you deal with uncertainty about current price levels. So you basically designate a certain number of dollars each month to put towards precious metals. You buy some gold coins, you buy some silver coins, you store them in one place, you store them in another place. The storage thing is a separate question. But you do that month after month after month. And when prices are down, you end up buying more ounces. And when prices are up, you buy fewer ounces. So your average price ends up being pretty favorable. Or at least relative to what it could be otherwise. And you hope that you've got enough time in which to build up these positions so you've got sufficient real money. And that's the real question. If it blows up on you tomorrow, you wish you had bought everything right now, but you can never know about that. So just a little at a time is the best way to go.
How are the commitment of trader numbers looking for gold and silver?
They've become irrelevant lately. Gold and silver futures action became extremely bearish a few months ago, which is to say the speculators in the futures markets became extremely bullish. When speculators take huge long positions in gold and silver futures, that usually precedes a big correction in price because the speculators tend to be wrong at big turning points. But they have been bullish for so long now that people have just stopped paying attention to the commitment of traders reports. And one possible explanation for that is that there's physical demand out there that is now swamping the action in paper precious metals because you've got central banks who are pretty aggressive buyers of gold all of a sudden. And you've got China and Russia who have been adding to their gold reserves continuously for a long time. Now they've been joined by some other central banks. So in total, you've got quite a bit of physical demand coming from governments, which is new, and so you just need a little bit of investment demand from there to send the precious metals through the roof. And it could be that physical demand is just swamping the paper market, which means that the guys who are short, all right, this is getting a little too technical, but I'll say it. The guys who are short while the speculators are long, normally win. They're called commercial traders, and they usually seem to be on the right side of big turning points. But if this isn't a big turning point now, and gold and silver are going to continue to go up for a while, that means those guys who have taken short positions against precious metals might get squeezed. They might have a thing called a short squeeze, where they all panic and they try to reverse out their shorts by going long, and that adds a lot of new demand to the market, causing the price of whatever it is being short squeezed to spike. That's possible with this kind of a structure in the futures market. So that would be nice from a gold bug's perspective, to have these guys who have kind of sort of manipulated the market for years and years finally get steamrolled by it and take massive losses while they're bailing out of their short positions and pushing the price up for the rest of us. So that's one of the happy possibilities that are out there for gold and silver. And I think it's, it's somewhere between a possibility and a probability, because they have those big short positions and the price keeps going up. So at some point, a short squeeze is conceivable.
Is the gold-silver ratio starting to favor silver?
Yeah, big time. It's favored silver for quite a while now. Normally, it takes, the amount of silver that it takes to buy 1 ounce of gold varies from, 20 or 30 or 40 at the peak of precious metals bull markets, all the way down to 90 or 100 during bear markets. In other words, when people aren't interested in precious metals, they're less interested in silver than they are in gold. So the price of silver relative to gold goes down. When people get excited about precious metals, they tend to bid silver up, and the price of silver relative to gold goes up. So the gold-silver ratio goes down. In other words, the price of gold relative to the price of silver drops. And so we're still in like the 80s right now, which is a really high ratio, which usually precedes a nice positive run in precious metals prices and an even nicer run in silver in particular. So if you're looking at that piece of history, and at fundamentals like the amount of silver that's available, which is not much, the amount of silver we're mining out of the ground, which is only about 10 times what the amount of gold we get, which means, it's conceivable that the ratio ought to be 10 instead of 80. It's really a favorable time for silver based on historical precedent. So this might be a time when you can buy it and not just preserve capital, but actually make quite a bit of money in the ensuing parabolic spike that we'll see at some point out there.
How are the seasonalities looking for gold and silver in the first half of the year?
Well, seasonality is another interesting story where it didn't work the way it was supposed to. Normally there's this saying in precious metals called sell in May and go away. And that's because Asians buy a lot of gold and silver to give as wedding gifts. And they have their weddings in the spring, which means they need to start buying their gold to be turned into jewelry in, say, December or January. So normally January is a great month, and the summer is when the Asians aren't buying, and those are usually really weak months for gold and silver. But this summer, they took off. We had a really good run for precious metals during the summer, during the normally, seasonally weak time. And now, we're in the normally, seasonally strong time, and it's really choppy. It spiked on the potential for World War III between the U.S. and Iran, and then it came back down when it looks like we settled that whole spat. And now it's kind of choppy. So we're not seeing the usual January run-up. And it's possible that we already had it. The price has already gone up enough. But it's also possible that there's still a couple of months of seasonality left that are positive. And that could still support precious metals going forward. So I wouldn't give up just because January hasn't been this straight-up line so far in their prices. And I would still be optimistic about precious metals, but the fact that both seasonality and the COT report don't really seem to mean anything anymore means that history is not the good indicator or the rock solid indicator that it used to be. So there's no real way to predict anything now.
The price of lithium looks like it's on the rise. Is that good for the junior stocks that are focused on lithium-ion batteries for electric vehicles?
Yeah. The suppliers to growing industries tend to be pretty successful just because they've got a bigger and bigger market every year to sell into, and that's a nice environment. And lithium is like that. The electric car market, along with solar plus storage systems out there, which use batteries in the basements of houses or on utility scale grounds with solar panels and stuff to store power. Those are really fast growing markets. So the demand for lithium will rise over time. But then you've got the supply issue, which is unclear. You know, for a while everybody was worried that we wouldn't have enough lithium because China had it all, and now they're finding it in a lot of other places, and it's a question of how fast the mines come online and how much they produce relative to the needs of the market, and that's a hard one to predict. So it's conceivable that there could be a lithium glut out there when all the new mines that are being developed come online. And that would be tough for existing operators because their costs are sunk. They need to make X amount per ton of lithium, and if it drops below that, then they're in trouble. So I think Rick Reaugh or somebody like that is a better source for information about what's happening right this minute in the market. But I will say generally that I think lithium and the batteries that they go into, that lithium goes into, are a growing market for the next decade at least. And at that point, fuel cells might become a viable competitor, and then we have to see which one of them do the job better. But for the next few years, there should be a lot of demand for lithium out there.
Would you buy an electric vehicle?
Heck yeah. They're really fun to drive. And they're getting cheaper. So you combine those two things. Right now, they're kind of toys of the rich for the most part. You know, Teslas aren't cheap. The new Porsche that's coming to market shortly here is going to be 6 figures. You know, they're expensive cars in general. And because of that, the demand isn't just robust. I mean, people aren't just completely ignoring internal combustion cars in order to get at electric cars yet. But I think the time will come when that happens, because they're really fun to drive. They've at least got a green-sounding story, although that's hotly debated right now. And they're really potentially cheap to operate because electricity is a lot cheaper than oil. And if oil goes up in costs and electricity does not, which is how it could easily work in an oil crisis, then the economics of electric cars versus internal combustion cars gets better. And that might be the kind of thing, like if we have a 2-year oil crisis and all of a sudden, you know, it's only half as expensive to run an electric car as a gas-powered car, then you'll see a huge amount of demand in the market, and that will allow the makers of electric cars to run longer production runs and generate economies of scale and lower prices. And at that point, you're looking at kind of a takeover where electric cars just become the main option and internal combustion cars become something that's sort of a specialty niche market. That's probably something that evolves over a decade or longer, but it's coming out there somewhere and could come sooner if there's an oil crisis.
Which sectors are you bullish on in the junior stocks?
Oh, the junior miners or the junior gold and silver miners are in great shape right now because they're still not expensive. Some of them are up 15, 20, 30%, and a handful are up multiples of that. But most of them are still pretty cheap relative to what they could be worth in a precious metals bull market. So what we're seeing now is the big miners acknowledging that their exploration efforts haven't been replacing the reserves they've been taking out of the ground. In other words, they're mining more gold than they're finding, so they're basically shrinking as companies. And that's not a good thing. So one way they're going to address that is by looking around for junior miners who have already found a resource that is big enough to move the needle for a Newmont or a Barrick or somebody, and they're going to snap them up. So you'll see the biggest and best quality exploration companies and junior producers be taken out in the next few years at pretty good prices compared to today's levels. So it will mean a bull market in junior miners, and it will generate the kind of excitement that leads people to look beyond just the top tier of the juniors to what's below that. And so you'll see a lot of companies that ordinarily wouldn't be thought of as great prospects really jump in price as all this new money and this indiscriminate money comes into the market. So I think you could see kind of a buying frenzy for a while in the junior miners, such that they start getting talked about as .coms for a little while. In other words, anything with gold and silver in its name will be very popular and really richly priced. And at that point, you want to start selling whatever you own now. You want to start handing your miner stocks off to people who just come into the market and are willing to pay pretty much anything for it. And that, you know what? The gold industry, the gold investors deserve that. It's been a long, long wait for this market to turn in a way that makes stackers and junior gold mining investors a lot of money. And the fact that it might be coming pretty soon, I'll tell you what, it's not a moment too soon. It's been a long enough wait, and it's really time for that to happen.
When you're taking a look at a junior stock, what kind of things do you look at? Some kind of investment advice there?
Well, I am definitely not an investment advisor, and neither am I an expert on junior mining stocks. There are a lot of other people in this space who you know, like Jay Taylor and Rick Reaugh, who can tell you from an expert's point of view what to look for in a junior miner. So I'll keep it very simple. You want to look at a management team that's done it before and has a good record, because serial success is the best indicator of future success. In other words, if they've already done this a couple times where they found a good deposit, they delineated it, they proved it up, and then they sold it to a bigger miner for a lot of money. If they've done that a couple of times and they've got another prospect that looks kind of like the first two, then they're a reasonably safe bet, because you can't know what's in the ground. And there are hundreds or thousands of people in this sector who are claiming to have things they don't have. So you need to find people you trust first and foremost. And then you need, for something to be a takeover candidate, okay, so let's focus on that to begin with. You need a deposit of a certain size. So it's got to be potentially pretty big, maybe several 100,000 ounces of gold a year for a decade or something like that, and preferably more than that. To get the kind of interest from Newmont, for instance, that you want, where they would actually send people to check you out and then offer you a good price for your property. And that takes a little while to do. And then you've got to be able to interpret the drill results, basically. See, the technical thing with mining companies is drill results. Every industry has its technical stuff that you've got to understand. And with mining stocks, you've got to know what they're seeing when they drill down into their property. And basically, you want a lot of gold and silver in the drill holes. And a feel for that you kind of get by looking at these things and seeing what number the market seemed to like and what number the market didn't. But basically, you want a property that's looking like it's viable on a fairly big scale. Now, how you find those is you plug into the network of people out there who are doing that for a living. There's Gwen Preston, who's a newsletter writer, and Jay Taylor, who I know personally and who's been at this forever, and they go out and they find these companies. And then you watch Rick Rule's interviews where they ask him what his favorite stocks are. And you'll generate a lot of names that way. Subscribe to one of those good newsletters. And then pay attention to YouTube videos of people who are successful in this field. Eric Sprott is another one. Those guys tend to know what's going on in this market. They tend to be involved in a lot of the best deals, And you can kind of piggyback on their work by just listening to what they say about what they're doing and then doing some of the same stuff. But this isn't a market where you can where you can do it on your own if you don't have some expertise, because it does require some basic knowledge of mining, and you have to look, therefore, way beyond just the price action. Just because something went up doesn't mean buy it. Learn about the company before you put money into it, because 90% of junior miners will go out of business. The 10% that don't will make you a ton of money, but you need to be in that 10% and not the other group.
Is the U.S. experiencing a boomerang bubble in real estate?
We're getting towards bubble levels. It's not crazy like it was back in the 2000s. You're not seeing people just do absolutely crazy stuff that you would never do in a normal market and then seeing them make a ton of money doing that stuff. That's not happening now. But prices are back up to levels in a lot of places that are comparable to the 2006 peak. And affordability, which is how hard it is for the average person to buy the average house in their area, is at record low levels. In other words, most people can't buy houses or buy the average house in their town. And normally when you get to that place, you've reached bubble levels and it can't go much further. So I wouldn't say we're in a capital B bubble, but I would say that the housing market in the U.S. is financially fragile because prices are so high and so much debt has been taken on lately to buy these high-priced houses.
Do you have some market wisdom you can leave us with?
Well, the important thing to understand now is that we're in uncharted territory. We're doing stuff that we've never done before, and most of it is absolutely stupid financially, and we'll pay a price for it. And you want to be ready for that, for normal to change. In other words, what you're used to now is going to be in the past, and this new thing that comes along will become your new normal, and you'll have to deal with it. So you need to think that through and start preparing for it. But at the same time, this is absolutely fascinating. This is, from a finance nerd standpoint, this is an amazing time to be alive because we're witnessing history being written and lessons potentially being learned. So this is the stuff that will be in textbooks a century from now about how you do not run a global financial system and how stupid the people who are running the financial system actually turned out to be. That will be what historians conclude about this time. And, we get to watch it unfold. So from a safe distance, this is going to be fascinating. Just be careful. Try to avoid being too hooked into this stuff and being too vulnerable to stuff that comes along as part of all this.
John, thank you so much for being on This Week in Money.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Coming up, Eric Hadik, next on This Week in Money.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYVresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. Inside spelled INSIIDE. Welcome back to This Week in Money, Eric.
Oh, thanks for having me back, Jim.
Eric, we're hearing predictions of gold running up to a major top in early 2021 or early 2022. Your thoughts on that?
Well, I would partially agree with that. I've been saying since late 2018 that I thought this next phase of the rally in gold would last from September 2018 into late 2020, possibly stretching into early 2021. So that aspect of the analysis you cited is certainly in in sync with what I've been looking at. And there's a multitude of factors that play into that, but one of the interesting things that I've seen and continue to see is linked to this 40-year cycle that you hear me talking about a lot. And I would, I'd even preface that by saying I don't look at this as some magical, mystical cycle where everything repeats 40 years later. History, tends to rhyme, not repeat itself. But there have been a lot of other both cycles and fundamental events and market kind of setups in a lot of key markets that have all led me to be expecting 2018 to 2022 to have some interesting parallels and some similar moves to 1978 to 1982, and one of those did involve precious metals. And again, when I would emphasize that rhyme, not repeat. I'm not talking about something like the just enormous exponential move you had in gold back in the late 70s, but similar timing of its trends, of its bottoming phase, of its move up, similar timing for key highs and lows, and that's what you've really seen. Back 40 years ago, it was 1976 when gold really kind of went through a secondary bottoming phase and then began to trend higher in 77 and 78, similar to what you saw in 2016 through 2018. It was back in 1979 that it really began to take off, much like we've seen in 2019. And at the same time, you had different geopolitical events that have their parallels to that time frame. One of the most salient is that of the tensions between the U.S. and Iran. And I came into last year really emphasizing that point and telling my readers that I thought, based on a host of factors and cycles, that I thought the tensions between U.S. and Iran would really hit the boiling point starting in November of 2019, which is exactly 40 years from the embassy storming and hostage-taking of November 1979, and that you would see just an intensification of those tensions play out between November 2019 and late 2020, much as they did 40 years ago. And what do we have but another embassy attack at the end of last year, and then things really starting to escalate between the U.S. and Iran. So there's a lot of credibility to this 40-year cycle, kind of that mentality of don't learn the lessons of history, you're doomed to repeat them. And some of these things happen on a 40-year cycle or periodicity, where you get things mimicking or rhyming with previous events.
Even if you paid attention to the history, is there anything you can do if this is some kind of natural cycle that happens?
I think there's absolutely a lot of things you can do, and that's where that whole idea of rhyming and not repeating comes into play. Maybe you get a spike in tensions, but you can already see that things have been moving that direction for the last couple of years. You could also view it from the point of things really, that conflict between the U.S. and Iran really kind of hit a peak in 1980, although they didn't disappear after that, but that was kind of one of the crescendos in there. And so you can also look at it from that perspective too, that hopefully we hit a peak without really going into the abyss or going over the top, if I'm using that analogy. And that things start to find some level of either normalcy or mellowing out a little bit. So I think that I don't look at these cycles as governing as much as I do timing. And, I often use the, analogy to even a clock on every given weekday. And, when that clock strikes 5 o'clock, does it actually make people stop working and get up from their desks and put on their coats and head out the doors and drive home? No, it doesn't make them do that. It times them. It signals when a particular cycle, in that case a kind of a 24-hour cycle or an 8-hour cycle if you want to look at it from the workday perspective. But it doesn't, it's not something that can't be overridden.
Is silver likely to run up to a major top prior to gold or alongside gold?
I think that we're going to continue to see the silver lagging in many respects, that a lot of gold's moves over the last 3 to 4 years have been more on the safe haven type of buying, and when certain geopolitical tensions hit a more volatile point or a boiling point, and so silver has just kind of lagged behind, and there's not a lot of indications from a chart and technical perspective that there's going to be much of a change to that over the coming year or so. You do see a couple of periods like you did back in the third quarter of 2019 where silver starts to take the lead a little bit, and you get a little bit more of its either industrial or inflationary aspect kicking in, and gold was in a point where it had kind of already run its course for that 3 to 6 month cycle. And so silver did take over the lead for a couple months in there, but then very quickly it reverted back to the norm. And you just look at even this last move up, that gold's entire, the parabolic part that started in late December, early January, was all on the tensions with Iran. And silver ran up, but wasn't even able to get back to its previous high of just a couple months earlier. So I think it's going to continue to play more of a lagging role.
What kind of a cycle are we in when it comes to crude prices?
Well, crude there's a mix of competing cycles, and it was very interesting to me back in 2018 that leading into the third quarter of 2018, I was discussing where crude had a very consistent 5-year and 10-year cycle, all projecting a multi-year high in third quarter of 2018, and there were some monthly cycles as well. But by the same token, you had 1 to 2 year, 2 to 5-year cycles and some monthly and weekly cycles projecting a 1 to 2 year bottom towards the end of the year. And sure enough, crude had a big enough move in there, topping in late September, early October, plunging into late December, that both of those cycles remain intact and were validated by the action that unfolded in the last 13 months since then. And I think that it's still constrained by those cycles. I did have some coming into play in January where I thought we could see a multi-month peak, and so I think that's a more near-term cycle that I'm looking at. But that's always filtered by specific price action and indicators that I use to either validate and reinforce those cycles or to tell me something's amiss, and to look for what the markets are telling me that maybe a particular cycle isn't going to be as pinpoint as I might sometimes expect them, or that something is changing, and to be aware of that. So the price action and the indicators that I use are the ultimate filter, and that's what I'm going to look for to validate what I'm looking for from a timing perspective. So all that to say is I think that the energy market is in a wider trading range. It did turn more positive quicker than I thought in December, and stretch up to more significant resistance levels that really are around $66 to $67 a barrel. So even that, the timing was a little quicker than I expected, but it still remains within the context of the broader cycles that I'm watching.
We'll have more with Eric Hadik when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Eric Hadik. Eric, are the metals used in lithium-ion electric vehicle batteries in a cycle?
If they were, I really couldn't tell you because I don't spend much time looking at that. So I can't say I really have anything to add to that conversation.
What kind of a cycle are we in when it comes to interest rates, which are at a record low in North America?
Well, that's one that's been very consistent through this entire decade, and even dating back to the 90s, where I've frequently highlighted this very consistent 4-year cycle that you have seen in Treasury bonds. And the most recent occurrences of that cycle were in mid-2012 and mid-2016. And that was when, mid-2016 was when you saw the peak in the bond market and corresponding low in long-term interest rates. And over the last 6 to 8 months, I've been looking more towards the next phase of that cycle in the middle of this year. And from a monthly perspective, I'm looking at May through July. But I think that bonds could put in a secondary top at that time. And I think that's when you could see a more sustained down move in bonds start to play out, which would imply interest rates starting to edge back up at first and potentially see something a little bit bigger than that a year or so out. And the important thing, too, is to remember, too, that market analysis is as much dealing with perception of rates as it is the actual change in them. So, even if middle of this year we haven't seen the physical rates change any, it's when I think that the perception would change from a little bit more negative economic and negative interest rate perspective to starting to anticipate the opposite as you play out 2020 and then into 2021.
Is there a presidential cycle for the U.S. stock markets?
There are several ones that I have watched and followed in the past, and even there's ones linked to the third year of an election cycle, but then it's whether it's incumbent, whether it's first or second term. There are some consistent cycles, but what I have really been looking at in the equity markets is a pretty unique convergence of several cycles. And that's another thing I should really point out with any of the cycles that I discuss, that on their own, I think there are several cycles that have an influence on markets, but to me they're only worth focusing on, putting much energy into when there's the synergy of multiple cycles saying something similar for a limited window of time. And so with equity markets, it's similar to that right now, where I've been discussing the 40-year cycle. We were just talking about that a little earlier with gold and with geopolitical, but I came into 2018 saying that I thought, based on a lot of factors, that 2018 through 2022 would have some distinct parallels to 1978 to 1982 in the stock market. And again, it's not the magnitude of every move, but it's the similarities in how the trends unfold, when their turning points hit, kind of the way the market acts. And really, in the last 2 years, the stock market has pretty powerfully validated that scenario, and I've even kind of enumerated some of this periodically just when I discuss it in my publications. But you look at the last couple years and go back to 1978, and the Dow set a 6 to 9 month bottom in February of 78. Then it rallied into September, October of that year. Then the markets reversed lower in early October and dropped 15 to 20% into the end of the year. Well, what did you have in 2018, 40 years later? Almost the exact same thing. The Dow set a 6 to 9 month bottom in February, rallied into September, October, turned down in early October, and several indexes and many stocks saw a 15 to 20% drop into the end of the year. So coming into 2019, I was looking for some similarities again. And in 79, the first half of the year, the Dow rallied in 3 distinct waves, peaked in the April-May time frame, and then had about a month-long sell-off. And there were already other factors looking for something similar this time around, but sure enough, in 2019, you saw a very distinct 3-wave rally into April-May of 2019, and then a multi-week sell-off. Going back to 1979, after that month or so sell-off was done, the Dow rallied to new intra-year highs into the third quarter, tested its previous peak from the 1978, and then saw another quick, sharp 1 month sell-off. In 2019, you had something very similar, Dow going up, spiking to new intra-year highs, and then seeing a 1 month sharp sell-off into late August. Following that, you go back to 1979, market rallied into the end of the year and then into the opening weeks of 1980, where the Dow spiked to new multi-year highs and then saw a very sharp sell-off over the course of just 4 to 6 weeks. And funny enough, a 2-year cycle that I've been watching, an 8-month and a 16-month cycle, and even now an 11 to 12-week cycle, have all been saying something similar, to look for a top in the second half of January and a quick sharp sell-off into February. So those monthly and shorter-term yearly cycles are saying, or are expecting, very similar to what the 40-year cycle would do if it paralleled what happened 40 years ago. So it's this convergence and it's this synergy that really kind of makes me stand up and take notice. And I mentioned a 2-year cycle. It's been kind of uncanny how throughout the whole last decade, every 2 years, starting with 2010, you saw this pretty quick, sharp sell-off into the period of February 2nd to the 13th. And in 2014, 2016, 2018 did the same thing. So you've got a cyclic argument for the markets peaking here in the second half of January and then seeing a quick, sharp sell-off at least into the first half of February. So there's a lot of other overlapping cycles that are more consistent, a little more reliable, and more in my focus than the presidential cycle.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
And just before we go away, can you tell us a little bit about InsideTrackTrading.com?
Yeah, InsideTrackTrading.com. Like you said, that's spelled with the extra I in the middle, INSIIDE, TRACK, amy.tsx.v. We provide all types of cyclical and technical analysis on the markets, pretty broad spectrum of markets that we follow, and we also have a variety of publications from a monthly down to weekly with interweek alerts that we offer. There's also quite a bit of educational material with technical trading tools. Our subscribers, we offer a 100-page manual with the weekly relay subscriptions, and there's an archive of dozens, maybe even hundreds of articles, reports, and excerpts on our websites, InsideTrackTrading.com and 40yearcycle.com, that can hopefully give readers a better understanding, a better look into my approach to the markets and my approach to cycles to see if it's something that really jives with their own approach to the markets.
Thanks again, Eric.
Thank you, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. He was speaking to us from the Chicago area. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Eric Hadik, and thank you for listening. If you have any questions for our guests or for the show, you can send them to info@howstreet.com. Now stand by for company showcase updates from American Manganese CEO Larry Reaugh and Cypress Development Corporate Consultant Don Mosher. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, thank you. It's always a pleasure to be on the show.
Larry, what's in the latest news release from American Manganese?
Well, we just announced that we'd be presenting and attending with the booth at the Resource Show now. I have a lot of anticipation for that. I think this is going to be the best one they've had in several years, and the markets are looking strong. So I think we're in the right area, and I'm looking at what's happening with investors out there. So I'm hoping this is going to be very beneficial to the company, and it gives us a chance to talk about our product and what we expect to produce from our recycling program, and the importance of our patents. And just to say a brief, I've said it 100 times, but just to say a brief word on that, as time goes by, people will begin to realize just how important those patents are for recycling lithium-ion battery industry, and that's something that we haven't been able to show in immediate results, but that will come down, that we'll be probably valued at some point on our patents, and I'm looking forward to that day too. But I want to let everybody know that intermittently this week has been pretty much a shut-in for a lot of companies. For example, out here at our offices, there were two of us that were able to come one day. There was absolutely nobody else. Out of 120 cars in the lot, there was two, and they were parked there for the last few days. So it just gives you an idea of the elements out there, and that's probably slowed down Cometco a bit too, but we're expecting at any time to get the results from our DOE lab testing, and I expect that that everything's looking good. We had to kind of reinvent the wheel on
disassembly of the from the aluminum. And, because it turns out they use some kind of a very powerful epoxy to put those pouch batteries together. But we solved that. And whether that's patentable or not, I don't know. But so this is a pouch battery that we're working on, and it introduced a few curveballs to us, but Cometco, with their expertise, got through that. Now, one of the big exciting things that has happened is the Blackrock CEO, Larry Fink, is talking about climate change and everything else, and is what he's saying. And by the way, the Blackrock fund is the largest in the world with $7 trillion, and trillion, that is, under management, and they're talking about putting sustainable industries to the head of the line. And if they're doing that, you can bet that all the other funds will be following suit, because when they decide that the environment is important, more important, as he says in the write-up that I have, than the actual profits, although you have to have profits or you can't keep running, but he's going to put sustainability ahead of profits, and so that's a great thing. That's going down the road. I think that would be very beneficial to us. We did a financing with a group out of New York, in which we received $80 million in a bridge loan. And for various reasons, the other $640 million didn't come in because these guys just dropped the ball after they got rid of the existing management, which I was included in. And that was an ADNAC, but I'm trying to recall at the time, I think that Blackrock was part of that syndication. So that I'll confirm at another time, because I don't have the records for ADNAC here, but from memory I think that Blackrock was involved. And so this is another big boost. I think we're coming into a real great year for sustainability, and specifically for recycling. It's something, and you got to remember, there's something that is needed. It's something that has to be done. And it has to be done in a fashion where it's not introducing more problems into the environment. And we have the solution for that, and I think the shareholders should look forward to a very robust year. And, this is a time to be recognized. I mean, people with proprietary technologies and haven't patented them, I'm always suspicious of black boxes, but, I've seen that too many times in my career as a CEO of publicly listed companies. And so I just want everybody to know that our patents, that was our major focus for the last 3 years. And now we're focusing on commercializing this event. And so that's kind of where it sits right now. It was a slow week, but I think everything I see excites me, Jim.
Larry, where are you traded, and how can people get more information about American Manganese?
Well, we're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF, and we're traded in Frankfurt under the symbol 2AM. Now, you can get all the information you want and do due diligence on us at our website, AmericanManganeseInc.com, or you can phone the company at 778-574-4444, or email me at lreaugh, R-E-A-U-G-H, at amymn.com.
Larry, thanks a lot for the update.
You're welcome, Jim.
My guest has been Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on January 17th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of House Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Don Mosher. He's the corporate consultant for Cypress Development. Welcome back to the show, Don.
Thank you very much, Jim, on this snowy Vancouver day.
Well, we get to be part of regular Canada for a week or two every year.
Yeah.
No sweat. Then we're back to rain and palm trees.
Now we know why we live here.
Don, what are prices doing in the lithium market right now?
I really haven't taken a hard look at what the actual lithium prices are doing, and it's a manipulated market because it's not a global market like copper or gold or anything, so it mostly runs on a contact basis. But based on what I'm seeing the major producers doing as far as their equity prices are, it looks like we've seen a real turnaround in the lithium space. I think this predictions of oversupply is way overdone. SQM is starting to approach their year highs again, or Albemarle, SQM is well up. They're trading at $30. Their high was 45. But, they've recovered 35-40%. And that's even with a court decision out of Chile, which has put a hold to any expansions for those two companies in the Atacama Desert. And that may be why they're rising up. I mean, everybody's taking a look at what is going to happen with the lithium supply, and I'm predicting that we're going to have shortages, and I know several other people are as well.
Geopolitics, how big of a factor is it, and is it a big relief for Cypress that your action is all in Nevada?
It's a huge relief for us. We've got a claystone project. Nobody's ever commercially produced lithium out of a claystone project, but the two big ones in Nevada are the Cypress project and the Lithium Americas project. And Lithium Americas is getting very close to their year high. They are trading at $5.60 today. They were all the way down to $3.60 here a couple of months ago. They've continued to move their project ahead, and I think the fact that they and Cypress are moving through PFS and into construction now is going to bring a lot of credibility into the market for the potential for claystones, Lithium Americas is definitely ahead of Cypress. They've found themselves a partner to work on the construction there. They brought in a company called Sawtooth Mining, and they've done a long-term mining contract to provide mine engineering, construction, operation, and reclamation services. They're a much more senior company than what Cypress is. I think they made about $70 million last quarter, whereas Cypress is a pure exploration play. But Cypress should have their pre-feasibility study out sometime in February. And I think as we look forward, the timing gets better and better for that PFS based on what I'm seeing from the producers out there. I think it'll be much better received, and it'll take on much more value.
Don, can you give us a bit of a background for Cypress Development and what it does?
So we went into Nevada 3 years ago. We started to take a look at these claystone deposits. Originally thought we were going to be looking at brines, and realized that the claystones would actually leach out into a solution. So we've continued to move that forward through a preliminary economic study, and have now taken it all the way through to where we're going to be releasing a pre-feasibility. We had a court case that has confirmed the ownership of our properties. We had someone come on our properties and actually do some drilling. And we're waiting a decision on what the damages being awarded to us are going to be. So between having secured the property, having a pre-feasibility out, which will tell you the flow sheet on how you're going to take the clay and run it all the way through to an end product, what your costs are going to be, and what your capital expenditure is going to look like based on how many tons you're going to produce on an annual basis, I think we'll start to see some significant interest in the company from the producers out there. Like Lithium Americas has a partner in Argentina called Ganfeng Lithium. It's a Chinese company. They bought 50% of that project. I'm sure we'll see something similar like that happening with Cypress in Nevada. Somebody's going to want to secure that domestic supply.
Don, where are you traded, and how can people find out more about Cypress?
We trade mainly on the Toronto Stock Exchange venture market under the symbol CYP, but Americans can buy our stock on the OTC market, CYP.V, and there is a Frankfurt listing, which is C1Z1. All our information is available on site, cypressdevelopmentcorp.com. All our engineering reports and everything else are available there.
Don, thank you so much for the update.
Thanks very much, Jim. Have a good day.
My guest has been Don Mosher. He's the corporate consultant for Cypress Development. I'm Jim Goddard. Our conversation took place on January 15th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of Howe Street Media Incorporated.